Good morning and welcome to the Killik and Co market update. It's been another very choppy week for markets, and we've been looking at some investor sentiment surveys, which unsurprisingly show that investor sentiment is not very high at the moment. One of the most widely followed ones comes from the AAII, which is the American Association of Individual Investors, and their survey asks investors if they're feeling bearish, neutral or bullish. And here on this chart we've got the results plotted over a number of years. The bearish investors are shown in the pink, the neutral is shown by the grey, and the bullish shown by the green. So at times when there's lots of pink on this chart, you can see that tends to correspond with periods of market weakness. For example, the dot-com crash of 2000, the financial crisis of 2007, the lockdown of 2020, and the current time. The good news is that periods of high investor pessimism tend to be followed by periods of strong market performance. So on this chart here, we've plotted the percentage of bearish investors shown in the pink against the S&P 500 index shown in the green. So you can see that the crash of the dot-com bubble was followed by a strong period of market performance, as was the financial crisis. At the moment, investor pessimism is at a very high level. In fact, it's at the highest level we've seen since 2009, and yet the market is relatively low compared to where it was at the end of last year. The S&P 500 index is now down by over 17% since the start of this year. Now, when a market is down 10%, we call it a correction. When a market is down by over 20%, we say we're in a bear market. So at the moment, the S&P 500 is approaching bear territory. However, if we look into the index in more detail, there's actually a big amount of divergence between different sectors. So here on the screen, we've got a heat map showing how different sectors have performed since the start of the year. And we've got the sectors that have done very well, showing in dark green, and the ones that have done very poorly, showing in dark red. So the standout green is clearly energy. The sector is up 40% since the start of this year, and that's mainly because a lot of big oil companies have benefited from higher oil prices. And then over on the right, we've got consumer staples, which has been reasonably resilient. It's only down 1.66% overall, and it does have some stocks that are up, including Walmart and Coca-Cola. Consumer staples is generally viewed as a safe sector, and people tend to move into it when they're fearful of the market. Now, looking at the red sections, we've got communication services, which is down 26.57%, and that includes stocks like Alphabet, the owner of Google, and Disney. And then down the bottom of the screen, we've got the tech sector, down 23.59%, and that includes Microsoft and Nvidia. So with this in mind, and looking at this huge range in performance between different sectors, it could be worth looking at your portfolio and thinking about whether there are any tweaks that you could make in order to benefit over the longer term. For example, do you have any stocks that have come up a lot or stayed the same? And could you potentially take a bit of money out of those and switch it into some stocks or sectors that have performed very poorly? And finally, cryptocurrencies. These are not regulated, and therefore, as a regulated investment firm, we are not allowed to give advice on them, and we're not even allowed to buy them for our clients. However, they have been in the news quite a lot this week, and therefore it feels appropriate to talk about them in a factual and non-advisory way. Most crypto assets have sold off quite heavily this year. Here's a chart showing the price of Bitcoin, which you can see has dropped over 50% since the start of this year. Previously, many people have suggested that perhaps cryptocurrencies may be safe havens, but this chart suggests this is not the case. Crypto assets have sold off along with the rest of the stock market. A lot of the news coverage this week has centered around Coinbase, which is one of the world's largest platforms for dealing in and for holding cryptocurrency. Coinbase published its results this week, and in the results was a comment that suggested that if Coinbase were to go bankrupt, its clients' crypto assets would be lost. And needless to say, that did lead to a degree of panic, leading to lots of people to withdraw their assets from Coinbase. That led to a fall in the Coinbase share price and falls in lots of crypto assets as well. As you can see by this chart here, the Coinbase share price has performed very poorly since its IPO last year. And this issue of security of assets is well worth a mention. If there is a regulated investment firm in the UK investing in regulated investments such as stocks and shares, there are very strict rules around how that firm has to keep its client assets safe. For example, at Killik & Co, we have to have all of our client investments in a completely separate account to the funds that are actually owned by Killik & Co. So if anything were to happen to Killik, the client assets would still be very safe. Investors in cryptocurrencies don't have quite the same protection. As the regulator said, "We expect firms to act in your best interests, but our regulatory powers don't cover how crypto asset firms conduct their business with you. Even if a crypto asset business is registered with us, we're not responsible for making sure that they protect your assets, among other things." On that happy note, let's move on to have a look at the calendar for next week. We're expecting results out from Experian, TJX and National Grid. If you have any questions or comments about the content of this week's video, please do get in touch by emailing us at info@killik.com. That's it from us. Enjoy the weekend and we'll see you on Friday.